Good evening, everybody. Welcome to the Wealth Mindset and Real Estate Investing virtual meetup. My name is Chris Price. I'm the host of the Wealth Mindset and Real Estate Investing meetup, and I'm also a managing partner at Boost Capital Group and the CEO and co-founder of Red Fox Multifamily. Before we get into the logistics for today, we're going to talk a little bit about our sponsors. We are sponsored by Wealth Mindset and Real Estate Investing. First and foremost, is open to all who are interested in growing generational wealth through passive real estate investing and increasing their financial intelligence. This meetup is for the busy professionals and retirees across various industries. The individuals in the group make a good living and have discretionary income to invest in real estate for its proven wealth building power, but don't have the skill set, or network to do it at speed and at scale. This meetup focuses on helping us all grow our wealth mindset by learning how to build and preserve wealth while developing and maintaining an abundance mindset. This meetup will focus on multifamily real estate investing, as well as other proven ways to build wealth through real estate, through passive investments. And we are sponsored by Red Fox Multifamily. Red Fox Multifamily helps pharmaceutical and life science industry professionals diversify their portfolios, add passive income, and get all the perks of real estate investing without having to do any of the work themselves. Partnering with Red Fox Multifamily makes investing in real estate completely hands-off, allowing investors to add passive income, build equity, and save on taxes, all while being in an investment vehicle that's backed by a hard asset. Now, we're also sponsored by Boost Capital Group. Boost Capital Group's vision is to become the premier partner for busy professionals and entrepreneurs seeking to build and preserve their wealth through passive real estate investments. So in terms of the logistics for today, as usual, we'll ask folks to mute their lines when they're not speaking, hold questions to the end of the presentation. Please note that this presentation is being recorded. This material does not constitute an offer or a solicitation to purchase securities, and this is information only and should not be construed as business, financial, or legal advice. I love to connect with people live. Please reach out to me via email, or you can scan the QR code for my contact information. Love to connect and start to build with you. Without further ado, let me jump into the agenda for tonight. I'm going to do a speaker introduction here in a moment with our guest, who I'm super excited to have on. Our speaker is going to go through a presentation. We're going to have a little bit of a guided Q&A style to be able to help everyone understand some of these important concepts that they need to understand to really build on their financial intelligence. We could not have a better guest to be able to come and talk to us this evening about that. So without further, let me go ahead and introduce our guest speaker tonight, our expert guest speaker tonight, with the title of the meetup being Retire Smarter, Building a Tax-Efficient Plan for Long-Term Wealth, with Mr. Paul J. Rizzo. And let me give you a little bit of a disclaimer here first before I get into the specifics. Paul Rizzo, investment advisor, representative, securities and advisory services through Cetera Advisors LLC, a broker-dealer and a registered investment advisor. Cetera is under separate ownership from any other entity. Rizzo Financial Group is located at 10575 North 114th Street, Unit 105 in Scottsdale, Arizona, 85259. And so let me read you a little bit of the bio for our speaker tonight, Mr. Paul Rizzo. So Paul Rizzo is president of Rizzo Financial Group and uses more than 29 years of financial services experience to help guide clients on their paths toward their investment goals. Paul holds a Series 7, Series 24, Series 31, Series 63, and 65 life insurance and variable contract registrations with Cetera Advisors LLC. After examining risk tolerance, time horizons, and income needs, Paul creates investment strategies that fit each client's objectives and life goals. He feels that true success is found not only in the accumulation of and preservation of wealth, but the comfort and communication in the process. Paul is an investment advisory representative with Cetera Advisors LLC. Paul feels it's most important to invest his client's assets where all investment decisions are made in his client's best interest. And he incorporates that philosophy in every client relationship. Paul holds a bachelor's degree in business administration from Wayne State University in Detroit, Michigan, and is also a graduate of the Accelerated Financial Planning Program at Arizona State University. Paul actively participates in ongoing extensive investments and retirement planning training to keep him on the forefront of industry changes. In addition to investment strategies and portfolio reviews, Paul offers a comprehensive range of financial planning to include retirement planning, senior income planning, insurance, tax, and estate planning services. Paul is a member of the National Ethics Association, and you can visit visit the website www.ethics.net or call 800-282-1831 for further information on that. What an amazing resume here that we have with Paul. I'm so grateful to have you here, Paul. We were just talking a little bit before we got started with the show and just about how we came to and got connected together. But I'd love to turn things over to you if you'd like to introduce yourself a little bit more beyond what I've shared this evening, and then we'll go ahead and jump into the questions for today.
Oh, thank you, Chris. It's really a pleasure to be your guest tonight and share some ideas that I think could be timely as people try to educate themselves about retirement and investments along the way. So I'm ready to, I think you pretty much gave a pretty lengthy bio. So I'm ready to go when you are.
Fantastic. I'll go ahead and you can share your screen. We can go ahead and do that. And I'll start asking some of the questions that we have that we prepared for the evening to really help people get into this. What I think is really great about the timing for anyone that's watching this right now or on the recording is that right now we're nearing we're in tax season and we're nearing the tax day and everyone got to perform their financial and their tax obligation. But it's always time, from my point of view, to invest in your financial intelligence. And so that's why I'm so grateful to be having Paul here to talk to all of us today and help everyone do exactly that. So we're going to talk a little bit about some questions here. And one of the questions that we want to get after is around strategies for minimizing taxes at retirement. Maybe, Paul, can you tell us a little bit about what strategies can investors or people that are just looking to build and protect their wealth, what are some things that they can do to help minimize their taxes in retirement?
Thank you. It's a great question, Chris. I'd like to start with just making sure everyone is on the same page when it comes to our tax rates currently, because I think there's sometimes a misconception on how the tax rates apply to each of us. Can you see my screen okay?
Yep, we can see just fine.
So this is the 2025 tax brackets for single filers, married, and joint returns and head of household. But what I wanted to just make sure that everyone understands, if you're making a certain amount of money, let's just say in this example, you're making $150,000 and $150,000, if you're single, that falls into the 24% tax rate. But how the tax system is, and I'm not a tax professional, but how the tax system is, the first $11,925 if you're single, or $23,850 if you're married and filing jointly, that's taxed at a 10% tax rate. And then you can see the next portion of money, whether it be 30,000, 38,000 or so, and 70 some thousand, that's taxed at 12%. So when you get to a level of 100,000 or 200,000, you're not paying this exact rate. You're paying a combination. It's a progressive tax system. So oftentimes it's much less than people think. And then another thing that people sometimes get a little confused is the capital gains. If you're buying something like real estate, that becomes your cost basis when you buy it. If you sell that for a profit within 12 months, that's considered short-term capital gains. And short-term capital gains is taxed at ordinary income versus long-term capital gains. And you can see here, this is the tax rate for long-term capital gains if you're unmarried or if you're married. You're in the 15%. And long-term capital gains is anything over 12 months hold time, whether it be a stock or a hard asset like real estate. If you hold it more than 12 months, it's long-term capital gains, and you get favorable tax rates of 15% for most people. You only get to 20% if you get over $500,000 or $600,000. But for most part, capital gains rates, long-term capital gains rate are often less than ordinary income rates. So one of the ways that I find that people, when they're looking to try to save on the taxes they pay, but yet they want to invest, one of the first ways that I try to get people excited about investing in what's called a Roth IRA. A Roth IRA is a little bit different than a traditional IRA. And I have a slide here that kind of goes over some of the differences. First and foremost, with a traditional IRA, you put money into a traditional IRA, most of the times you're getting a deduction or it's pre-tax. So when you pull money out of a traditional IRA, it's taxable. A Roth IRA, the money goes in after tax, and that growth that you achieve over the number of years you hold it, if you hold it over 5 years, it comes out tax-free. So if you started a Roth IRA when you're younger and 20 years later, your money grows to, let's say, $100,000 or $1 million, when you pull that money out for your retirement or your needs after you retire, typically it's 59.5 without any kind of penalty. If you withdraw prior to 59.5, then there's a 10% penalty. But if you pull money out of a Roth after a 5-year period and you're over 59.5, then that money comes out tax-free, which is very advantageous. If you're an independent, maybe a 1099 individual, there's other strategies like using what's called a SEP IRA, which is a simplified employee pension. And there's some tax advantages, ways to reduce your taxable income and at the same time contribute to a retirement plan. So those are some ways I encourage people to think about establishing a Roth IRA for tax-free income down the road. And now many companies that offer 401ks, they have a Roth 401k option, which again, the money goes in after tax and grows tax-free.
Maybe, Paul, we can talk a little bit about this from the IRA perspective. So one question that came to mind for me was about being in the space and knowing about IRAs. And then we talk a lot about self-directed IRAs. And then there are also solo 401ks and that type of vehicle, which is in some ways similar to the self-directed IRA, but also has some differences. What, in your experience, what do you typically see in terms of solo 401ks, and what advantages or disadvantages does that provide in comparison to the IRA?
You're limited to how much you can contribute to each of those. So for an IRA or a Roth IRA, you first have to have earned income. But if you're under 50, the maximum you can contribute each year is $7,000. If you're over 50, they give you a catch up of an extra $1,000. So you can contribute $8,000 each year to a Roth or a traditional IRA. With a solo 401k, the limits are a little bit higher. If you're under 50, it's $23,500. And then if you're over 50, they allow you to contribute up to $30,500. So that is one of the benefits of a 401k over an IRA, because you can contribute more.
Yeah.
Now, a self-directed IRA, I'll just touch on that. That's typically where you want to buy real estate in an IRA. There's certain custodians out there that allow you, they're called self-directed IRAs, and they allow you to buy either businesses or real estate within that IRA for the purpose of, for growth or tax benefits. Normal IRA or Roth IRAs don't allow for real estate holdings. You have to be in a self-directed IRA setup for that.
Folks could, if they desire and it made sense for their financial approach, they would be able to potentially roll some of the eligible funds into a self-directed account to be able to do those types of things.
Oftentimes, you'll see people, if they're wanting to purchase a house, they'll take money from their 401k, roll it into a self-directed IRA, and are able to purchase real estate in that capacity.
And I know that there's different types of rules when folks have to do that. When if they're purchasing a house for investment purposes, it has to be for those purposes only, and they would not be able to live in that house in those instances when they're purchasing like a single family home or something along those lines. That from a real estate perspective, they can't materially benefit from it directly, but it is definitely a strategy that I've seen many people across the real estate space leverage, either in investing in residential properties like single families, or as a part of diversifying their portfolio, investing in syndications and funds as just another way to invest in real estate.
Yeah, exactly. I wanted to also touch on, for those that are older, specifically if you're in a traditional IRA that has been growing tax deferred and you have never paid taxes on that, the government makes you take money out of an IRA or a 401k at age 73. It's what's called a required minimum distribution. So a lot of times people don't need the income, but they're forced to take it out anyways. And once it comes out, it's taxable, and it often can put them into a different tax bracket. We tried to help manage the tax liabilities of our clients. The required minimum distribution has to come out by 12/31 of the given year you turn 70, and every year thereafter.
Maybe Paul, if you could go back to that slide, do we understand what the government, or maybe this is a loaded question, but maybe no one ever understands what the government is ever doing anytime, but maybe my thought process in the questioning is, what are they trying to control for here? People, are they trying to control for people just using this as a vehicle to shelter wealth, or what are they controlling for by forcing people to take minimum distributions at age 70?
Yeah, no, that's a good question, Chris. Primarily because this money oftentimes goes in without being taxed. It grows tax deferred for sometimes 20, 30, 40 years. So the government hasn't received any tax income from those funds. So they want to get paid. They force people to take money out, so then they have to pay taxes on what they take out. Now, one of the benefits of a Roth IRA, not only does it grow tax free, but there's no required minimum distributions on Roth IRAs. So you never have to take money out of a Roth once it's in there. There's not a required minimum distribution on Roth IRAs. So that money can stay, and you have complete control of when you use that money.
Got it.
And it's based on the amount you have to take out is based on the total value you have in all of your IRA accounts. So you can have multiple IRA accounts, even like a self-directed IRA. The total value of all your accounts at the end of a given year, in this case, you have to be 73 or older, but they take the aggregate balance of all of them combined, and based on your age, they would divide it by what they call the life expectancy. So for example, if you're 75 and you have $1 million of all your IRA money combined, you would take that $1 million and divide it by 24.6, which you have to take out approximately $40,000, or about 4% that year. And then every year thereafter, you can see the older you get, the higher the percent you have to take out. So it's something that you need to consider, because oftentimes you're taking money out that you may not need, and it may put you into a higher tax bracket, and that may affect other things like Medicare expenses and things of that nature.
Interesting that an IRA, Roth, or traditional that exist out there, or I understand the contribution limits on an annual basis, but if it were to grow if someone's IRA were to grow to a certain number, is there any maximum that can happen there, or is
No,
there? Okay.
there's no maximum. In fact, some of those early Facebook shareholders that bought those shares, let's say in their Roth or their IRA, particularly their Roth, people can become multimillionaires and have all that money in their account tax free.
Wow. Unreal.
Yeah. Another investment category that when people are looking to limit the amount of taxes they pay, if you're investing in the bond market, there's corporate bonds, there's government bonds, and those are typically the interest that you earn on those bonds are typically taxable. There's some tax advantages with government bonds, but corporate bonds, for example, that interest is fully taxable. One type of bond that is not taxable is a municipal bond or called muni bonds, and they're offered by state and local governments, municipalities. Let's say, for example, if there's a main street in your town and the city that you live wants to widen that main street, they need funds to widen that. So what they'll do is they'll issue a municipal bond. Then us as investors will invest in that bond, and the city, the issuing entity, would pay us tax-free income on that. And at some point in the future, whether it be a 10-year bond or a 20 or 30-year bond, you would get your principal back. But all along the way, it would provide tax-free income. It's federally tax-free. It can be state and local tax-free if you're buying or investing in a bond that's in the state that you live. But that's another, for the wealthy people that want to save on taxes. If you have $1 million in municipal bonds with a coupon of 5%, then you're getting, let's say, $50,000 in tax-free income. Federally tax-free, could be state and local if it's issued by an entity that's in your state.
Yeah, that's such a good one. And then what I understand from the bond perspective is historically these, especially these municipal bonds, these are pretty safe. I guess nothing is without risk. However, these bonds I understand to be more from a risk perspective, very low risk and a larger likelihood that the issuing entity, the local government, state government, whatever the case may be, is going to make good on their promise.
Yeah, they are typically considered less risky. There's primarily two types of municipal bonds. General obligation bonds, they're backed by the full faith and credit of the issuer, let's say the city or the state, and a state or city could increase taxes to pay for those bonds. Whereas the other type of bond is a revenue bond. And that's typically, they generate revenue based on an airport revenue or a highway toll or a utility. So general obligation tends to be a little bit more safe than revenue bonds. They're considered a little bit more safe. Overall, everything has risk. I'm originally from Detroit, the Detroit area, and Detroit went bankrupt several years ago. I don't know exactly how the bonds played out with the Detroit bonds, but there are some risks associated with municipal bonds as well. I think you,
Yeah. So thank you for taking me through that. I think this is really important from a strategic standpoint on various different ways that folks can minimize taxes in retirement and different tools that people, if they don't have them, should definitely explore it and talk to right professionals like yourself to be able to unpack those things. I want to maybe pivot a little bit now to another question around how people can potentially leverage alternative investments for tax deferred or tax free growth. Because for a good portion of my audience, they are here to learn about real estate investing or alternative investing, including real estate. You mentioned even earlier, folks leveraging their IRAs, buying businesses, different type of private equity type of things that may exist out there. There's a host of different things when it comes to alternative investing. I wonder if you could tell us a little bit about this from a strategic standpoint and how people can leverage these
yeah,
alternative investments to help benefit them from a tax perspective.
yeah, it's interesting because not many people invest in alternatives. but it can be a very powerful way to diversify. And there are many benefits to investing in alternative investments. So I guess let's go through just some of the types of alternative investments that are out there. You have private equity. You have publicly traded companies, which is considered public companies. And then you have private companies that are not traded on the stock exchange. And there are investments in private equity where you can get some very good appreciation, but there's obviously more risk. There can be more risk if you're dealing with maybe not a financially strong company, but real estate is a very good tool on a alternative investment that's used by many people. You can buy hard assets like actual real estate, buy your secondary property or what have you, multifamily. But there's also what's called real estate investment trusts, which are packaged products of real estate, portfolio of real estate that provides some tax benefits. Gold is making a new high this year. It's done very well. That's a part of a commodity, gold, silver, agricultural products. That could be a good diversifier. Futures is a strategy using a lot of times commodities. These are packaged mutual type fund investments or private investments that take into account commodities and the movements of currency and things of that nature. And then there's hedge funds, private debt, or alternative credit. Global macro is a type of investment that takes into account investing on a global basis as well. But the key to all of these is we add alternatives to a portfolio to reduce the overall risk of the portfolio. It's a hedge against inflation in many cases. It provides you diversification. It's not typically correlated with the stock market. So when the stock market goes down, most alternative investments either stay flat or maybe even go up. So they're non-correlated or inversely correlated in many cases. Many of the alternatives like real estate provide passive income, like you mentioned, an income stream. There's tax advantages. And more importantly, when you add alternatives to a portfolio, it actually reduces the overall volatility and risk in a portfolio. This chart here from JP Morgan basically shows that. And I'll just highlight a couple. If you have a portfolio of 80% in equities, which is the stock market, and 20% in bonds or fixed income, you can see that the standard deviation measured by the volatility measured by the standard deviation is 12.7. And the annualized returns have averaged 9.8%. That's 80-20, 80% stocks, 20% bonds. By reducing the stocks or the equities from 80 to 60, and then keeping the bonds at 20, but then adding 20% in alternative investments, you can see that it actually reduces the overall volatility of the portfolio and increases the returns. So there is some benefits of adding alternative. And when you look at some of the biggest endowments, university endowments and pension funds and things like that, they have a fair amount in alternative investments, sometimes 40, 50% in alternatives, and much less than people think in the equities. A good way to diversify your portfolio and reduce the possible risk you're taking.
So very interesting. I think many people, as you mentioned, people investing in alternatives, for the folks that do, they are typically very savvy investors, folks that understand how to approach things, how to provide more stability in their portfolio and this diversification strategy and this chart that you're talking about, and working with the right team to be able to do that. So I think that's so important for people to realize that. And one of the things that I love about having this platform is to be able to help provide this type of education or information to people so that they can understand these different types of strategies that exist out there that they may not be aware of in terms of how they can go about building and protecting their wealth. Great insights here on this one in particular.
I would just say, typically, you're not adding alternatives to a small portfolio. You have to have a considerable amount of money or portfolio where it would make sense to had a small piece in alternatives. You wouldn't do it with a $10,000 account. You would do this with much larger portfolios.
Yep. Great point. So maybe you can talk a little bit more about real estate in particular and how folks can leverage real estate as a passive investment to help boost retirement income.
As a financial advisor at a wealth management company, we can't offer hard assets from a standpoint of like actual physical real estate, but we can offer other forms of real estate investing in the form of mutual funds or what they call real estate investment trusts. And those do offer some tax benefits. So at times you can receive favorable tax treatment. I'm not a tax professional, but there's ways that real estate investment trusts, many times they're paying like return of capital, which reduces your cost basis. And there's favorable tax treatments later on in the investment life. I know a lot of your folks that are in your group do more of the hard assets and the multifamily, and those type of investments provide obviously passive income. But like any investments, there's risks and there's work, especially on the private side where you're actually buying real estate and dealing with tenants and all of that. That's not really my world. I'm more on the real estate investment trusts.
Yeah. Which I think is really another option. And I know that when it comes to REITs or real estate investment trusts, I would love for you to maybe take a little time to explain to folks a little bit more about REITs and what they are and how they're similar to private real estate investments, or maybe how they're different, because I understand that there are some similarities and differences in that. Yes, real estate is involved in all of those different types of things. But what I also understand is that, for example, income generated by a REIT and how that comes into an individual may be taxed at a different way than someone who is maybe receiving a distribution from a private real estate investment. Maybe you could talk a little bit about that so people can understand a little bit about the similarities and differences around REITs and versus private investments.
One of the nice things about real estate investment trust is it's a diversified portfolio. So you're not just investing in one property, you're investing in multiple real estate investments, oftentimes in different industries. So one diversified real estate investment trust could have multifamily, could have single family, could have industrial, could have apartments, could have student housing, could have retail. There's a lot of different areas of real estate. And when you buy into some of the real estate investment trusts, you're getting a diversified portfolio. And typically they most often will pay income on a monthly basis. So it is good for people that are looking for another stream of income. Could be beneficial to people that are looking for income in retirement or what have you.
Great stuff. So we were also, one of the other things that I wanted to make sure we had an opportunity, if we hop back for just a second here, because I want to make sure I don't miss this point. And it's about life insurance as a potential strategy for folks to talk about. Maybe we could take an opportunity, but before we dive into some of these things and understand a little bit about annuities and life insurance strategies for tax deferred growth also.
Life insurance is one of those things that many people don't want to necessarily invest in or spend money on, but it's really important to protect your loved ones with life insurance to make sure that if something were to happen to you, your family is taken care of. So I typically do a needs analysis based on what would have to be paid off if the breadwinner, let's say, were to pass away, if there's a mortgage that needs to be paid off, if the surviving spouse needs an income stream from the proceeds of a life insurance policy, are there young kids that will be needing to go to college? So it all depends on the needs of the individual. We factor in all of the needs to come up with an amount that people would need to hold as life insurance. But another way for life insurance from a standpoint of building wealth, not only will it protect your loved ones, but many life insurance policies can build cash value and allow you to build wealth. And one of the nice things, if it is building up cash value down the road, you can take a loan out of the cash value, take it as a loan, and that money is considered tax-free income. So not only does it grow tax deferred, but if it's structured right and it builds cash value, that could be another source of income in retirement with the tax advantage of being tax-free if it's taken out as a loan. So that's one of the benefits. Annuities are another investment primarily for tax deferred growth and income as well, to supplement other forms of income like Social Security. If you have a pension, an annuity is like creating your own pension issued by insurance companies. So you have to make sure that obviously the insurance company is a strong insurance company, and the annuities, there's some annuities that have fees that you need to be sure you understand. But yeah, life insurance and annuities can be some good components of an overall wealth plan. But again, it's individual by individual basis.
The life insurance policy is definitely something that we become very fond of, and as a strategy, leveraging life insurance as that sort of dual asset, protecting the human life value, but also building up that cash value, using it strategically to invest in real property, and then bringing in some cash flow, using some of that cash flow to pay off the loan, and then building that back up and then rinsing and repeating the process. But no, definitely a great tool there. Thanks for sharing that insight.
And one other thing that's become a little bit more popular more recently is many of our parents are facing long-term care needs, whether they're in assisted living or nursing homes. And the expense associated with long-term care can be over $100,000 a year, could be $8, $9, $10,000 a month. And one way that you can provide for some of that expense, offset some of that expense, if you have a life insurance policy that offers a long-term care rider, then you're able, while you're living, to tap into the death benefit of that life policy to use for long-term care needs while you're living. And whatever is used on that type of scenario would get reduced from the death benefit that ultimately goes to your heirs. But it's another way to be able to tap into a life insurance policy if you end up getting one with a long-term care rider that would provide for access for long-term care needs.
Great insight. Maybe we can hop back into the passive real estate investments to boost retirement income, to talk a little bit about benefits of real estate investing as a passive income source.
Yeah, I think there's some tax benefits. Obviously, I'm not a tax expert. I can't really talk too specifically about tax, but there's mortgage interest deductions, capital gains. If it's long-term capital gains, you're taking advantage of a lower rate than short-term capital gains. You can take advantage of depreciation. The 1031 exchange is probably something that your audience is probably pretty familiar with. It's called a like-kind exchange. When you have a real estate that you're selling it that has a big capital gains, if you exchange it into another real estate of a similar property, you can defer your capital gains tax on that. But that's a strategy that you have to work with your CPA to make sure it's done correctly. Real estate also, if you have a rental, it acts as an inflation hedge, because as inflation rises, everything starts to cost more. But with real estate, you can increase the rent as well. So rental income that you receive often goes up with inflation. So it acts as a hedge against inflation. And then, as we mentioned, passive income, cash flow, and building up your overall portfolio building your wealth over time.
Yeah. No, thank you for hitting on that. Can you dive into a little bit about how to go about evaluating? We talked about REITs, in particular, real estate investment trusts and private real estate investments for diversification. Can you maybe share a little bit about that? Because you did talk about the fact that all investments have risk and people need to tread carefully as they are evaluating these things. Can you maybe share a little insights from your perspective on that?
Can you just rephrase that question? The insights on the risks of real estate, or
On the evaluation of REITs and private real estate funds for diversification.
yeah, not when I look at when I'm building a portfolio, we're always very aware of the amount of risk that we're taking. And when you're building a portfolio, we want it to be diversified. And I use a particular strategy where I have multiple buckets of money. But one of the nice things about adding alternatives to the portfolio, it provides not only another source of income, but it also reduces the overall risk associated with the portfolio. Because a lot of those, like for example, this year, the stock market's been going down more than it's been going up. Gold as an alternative has been going up. So that has not been correlated to the stock market. It's been making new highs as the stock market is showing a lot of volatility. Real estate, typically when interest rates start to come down, real estate will do better as well. So there's different types of alternatives that will do better than other types, depending on the economy and interest rates and what's happening in the world.
Got it. So, Paul, I know we're getting close to the end here. Want to give you an opportunity to share any final insights or key takeaways and action items that you want to leave people with.
Yeah, I think that it's just most important to work with a financial advisor and make sure that they understand your goals. We all have different goals. So you want to make sure they understand what's important to you and the level of risk that you're comfortable with. Once you share that with an advisor, they can build a plan that's specific, catered to you and your family and what your needs are. Not all investments are going to be right for everyone, but depending on what a person's needs are, and obviously if someone's in their 20s, they have a long ways to go and they may be more comfortable taking more risk because they have time on their side. Whereas someone that's older may not want to take that added risk because they don't have time to recover from a down market. So it's really important to know what's available and to set up a plan for yourself. And that's what we do for our clients. Sit down and determine exactly what's most important to each person and help them develop a plan that will allow them to build wealth and then ultimately be able to retire and have income that they need to live the lifestyle they want.
Absolutely. Thank you for sharing that. I'm going to jump into some of the questions that we ask all of our presenters here. But before we do that, I think you want to share this information.
Yeah, these are just disclosures that I need to share. We talked about Roth IRAs. If you convert from a traditional to a Roth, that's a taxable event. So you have to be aware that you can convert from a traditional IRA to a Roth, but the amount that you convert becomes taxable at the point of conversion. But once it's in the Roth, it grows tax free. If you hold it for over 5 years, you pull it out tax free. Obviously, a diversified portfolio, you have to make sure that you understand the risk you're taking in a portfolio, adding alternatives, know exactly what you're investing in and what the pros and cons and the risks are associated with that. Annuities and life insurance. There are pros and cons with annuities and life insurance. Just make sure that you understand what those are, the fees involved, and what the ultimate objective is. And just to know that there is risk in investing, and just be sure you're working with somebody that understands what your level of tolerance is for that volatility and risk. Are you on mute, Chris?
That was my apologies. No, we'll leave those up there so that so that people can read through them for the disclosures. But while we leave them up there, what I'll also do is I'll take an opportunity to ask you a few quick questions just as we wrap up the show here that we ask all of the guests that come onto the show so that they can really connect with the viewing audience a little bit more, allow them the opportunity to know who you are a little bit more beyond what we shared today. The first question that I have for you, I know you're based out of Arizona in the Scottsdale area. I love that area. I've spent a lot of time in Tempe and Scottsdale and the Phoenix area. I have a good buddy that I went to that was my roommate in college who lives out there in the Phoenix area. So I love the area, but you probably travel a little bit as well. I want to actually, one of the beautiful places that I traveled actually is Sedona, Arizona. I tell people
Uh,
that all the time to get out there. But what is one of the best trips that you have ever taken and why is that?
I have gone on a lot of trips, but the one that comes to mind off the top of my head is when I was a little bit younger, I backpacked throughout Europe for about 3.5 months. And we visited about 13 countries. Some of the highlights were hiking the Swiss Alps, running with the bulls in Spain, Pamplona, went to the Greek islands, went to the Vatican and saw the Pope, and a number of very cool things to do. We did that summer, but that was probably one of my favorite trips. And the experiences that trip was very rewarding.
So that sounds amazing. A few years ago, my family and I, we went to Greece, had a beautiful time. I've been to spots in Italy, but never been to the Vatican and the Swiss Alps. A buddy of mine shared pictures that he and his wife went there for their honeymoon during the summertime. Most people think Swiss Alps, they think skiing in the winter.
I,
This in the summer, it looked absolutely like you couldn't make it up. Amazing. The other question that I want to ask of you is, as a financial advisor, entrepreneur running a business, you probably have a number of different things that you're working on. What's one of the top things that you're working on these days?
a good portion of the clients I work with are nearing retirement or already retired. And I have a website I created called retirementroan.com. And we're in the process of building that out to be a source of very timely information. People that are nearing or already retired would look for information about Social Security and proper diversification, when to take Social Security, Medicare type questions. It's going to be a website with resources, videos, blog posts that people can go to. It's still being worked on at this time, but I am working on that. And I think it'll be a good source of content.
Excellent. Yeah, please do let us know when that comes out. Great for us to help you put that out to our audience and let them know about this tool. So please count on me to do that.
Thank
Um,
you.
You bet. When it comes to financial freedom, I'm sure in your line of business, you've come across a lot of people who are financially free, but financial freedom means different things to different people. What does financial freedom mean to you?
Yeah, that is a good question. I think financial freedom, it really is being able to do what you want, when you want, and with whom you want, and not having to answer to anyone, maybe your spouse. But no, I think that's when I think about financial freedom, it's just being able to do the things that you want and that are most enjoyable to you in your life.
Absolutely. And the last question is one in which the name of this show is based on, and it's about wealth mindset. And it's this part of my journey that coming to this was around developing an abundance mindset, a wealth mindset, whatever you want to call it. But I wanted to make sure that it was something that really resonated with me at the time of the inception, if you will. In a similar question, what does having a wealth mindset mean to you?
Yeah, I love that question, Chris. I think when you have a wealth mindset, you're curious and you're not afraid to ask questions and learn. When you have a wealth mindset, you're about building relationships. There's I don't know the phrase or the coin, who actually came up with it, but it's called relationship capital.
Mm, yeah.
And it's the relationships that we build you're just one relationship away from something big happening in your life or life-changing events. So always keeping a wealth mindset is always keeping open the possibility of meeting people, looking to meet people and engage with people. I also think that wealth mindset means not wanting something or asking for something. It's about providing value first, adding value to a relationship before you look to take from the relationship. I think that's a wealth mindset. I think those people that have a wealth mindset are always looking to improve, to grow, to learn. And I think one of the best ways we're talking about investing in real estate and investing in the markets and things like that. I think the number one place to invest is in investing in yourself. And I think those people that invest in themselves, I think are probably have the biggest wealth mindset and often turns out to be a great investment.
Awesome. I could not have put it better. Thank you so much for sharing that. For people who are live and for people who are watching the recording when we post this on our YouTube channel, what is the best way for them to get in contact with you?
Yeah. So my website is rizzofinancial.com. You can call my office. That number there happens to be my cell phone, but my office number I can give is 480-248-8029. I also am on Facebook. You can search Rizzo Financial on Facebook, Paul J. Rizzo on LinkedIn. Those are some ways to contact me. But on my website, there's also an area to contact me. But any of those ways, I'm more than welcome to answer any questions you may have, or if anything that we talked about sparked anyone's interest. I would love the opportunity to talk with anyone and help any of your audience out any way I can.
Paul, thank you so much. We'll make sure that we include those details in the show notes and the YouTube description so that people can access it and get in contact with you. I want to thank you again for taking the time out to bring value to the audience. And I want to wish you a great rest of the evening and wish everyone else a great rest of their evening and great day as well. And we'll talk to you soon. So thank you.
Thank you, Chris. It's my pleasure.